current basis, we will start the show off today, and the first man going to be introduced is Mr. Brad Bellinger, who is the chairman of the Australian Beef Association, and Brad will be presenting the model they believe is the best interest for the cattle industry. Thank you, Brad.
Thanks, Ashley. Just slightly wrong. Linda's going to present that model, but I've got the unfortunate task of explaining to you how the red meat industry structure works. So I'll go back in time. The year was 1998. John Anderson, the Federal Minister of Agriculture, decided to dissolve the old AMLC, the Australian Meat and Livestock Corporation. So the AMLC was the statutory government marketing authority. So he changed that and formulated Meat and Livestock Australia, a company limited by guarantee. This is the complex structure, which I don't expect you to understand in a brief showing, that John Anderson formed. So it involves a lot of entities representing various groups, but the main aim that John Anderson and his writers had was to bring all parts of the red meat industry together under the one banner, and it hasn't worked. When you bring in processors and producers together and also allow the influence of the retailers into the red meat industry structure, there is some group which is going to dominate and dictate terms over the other ones. The domination now within MLA is from the processing sector. We pay $5 in levies which benefit the retail sector. Next slide. This slide gives a basic overview of the flow of money, which is the most important aspect. So you, the levy payers, grab David's stick. So you, the levy payers, pay $5 into the government. That money, which is collected by DAF, is then transferred here straight into MLA. They also have a donor company which allows entities who wish for joint R&D funding to also put money into MLA. LiveCorp, on the other hand, has its own funding arrangements, and with that funding arrangements, they are allowed to control the expenditure of their levies. The Australian Meat Processing Corporation are similar to LiveCorp in that they have the ability to control the expenditure of those levies. Next slide. So, as I said, John Anderson changed the red meat industry structure. He not only formulated MLA, but he also formulated a body called RMAC, the Red Meat Advisory Council. So the Red Meat Advisory Council is the overarching council which manages the fund. Now the fund is a $40 million block of money left over from the old AMLC. So when that was dissolved, $40 million was given to RMAC, and RMAC had under it 5 peak councils. So those peak councils, which include AMIC, which is the Australian Meat Industry Council, which are the processors, ALPA, which is the lot feeders, ALEC, which is the live exporters councils, and the one that concerns us today, the Cattle Council and the Sheep Meats Council. So they manage that fund, and each year, as well as taking dividends from that fund, they also give money to those 5 peak councils in the form of disbursements. So, for example, the Cattle Council's current funding arrangement from RMAC is running at about $530,000, and each peak council has a dividend from that RMAC fund. Now, the trouble is with this RMAC fund, and I'll get to just the cattle produce and sheep produce in a minute, is that RMAC, in order to make policy decision affecting the red meat industry, must have complete agreement from each of the 5 peak councils. in order to push that policy through. So when we saw the suspension of the live export trade to Indonesia, of course the Cattle Council were dead against it, but the processors wanted it shut down. So because of the conflict between AMIC and the Cattle Council, AMAC did nothing. Let the Cattle Council swing to try and lobby the government for a speedy recovery of the trade. So that's the problem we've got. It's the processors who want the live trade stopped so they can get cheap cattle, which they now have got cheap cattle. And this is the problem we have with Cattle Council, that they didn't have the support of RMAC. And they've got a lot of black over, but it's the structure is the basic problem. So these are the revenues which MLA receive every year. And the section, I don't know whether you can see, we're looking at a total revenue base of about $160 million. Grass-fed cattle levies range from $56 to $52 million, 8.5 to 8.1 for grain-fed cattle, sheep about 28 million, lamb about 28, mutton 2.6 million. The processors contribute 9.3 million, because I say they have most of the say when I get the voting structure in a minute. And then the government contributes about 40 million, which is used for R&D, matching dollar for dollar R&D funding. Next slide. So we need to, that's a very rough overview of the structure and the problems we've got within that structure. But before I get to the performance of MLA, I quickly want to touch on how impregnable MLA has become. So as you know, the ADA have been pushing for a restructure of the red meat industry, and we've gone to the MLA AGMs with various motions. Those motions have included getting rid of some of the directors of MLA, and twice we have tried to wind up the company. The first time in Launceston 3 years ago, we had 15% of the vote. Longreach, unfortunately, it was even worse for us. We managed to get only about 10% of the vote. But the problem we've got is that there are 200,000 producers who pay a levy if you have sheep or cattle into MLA. And we know, we've always said about 200,000, which has been denied by the industry, but it's interesting to note that there's about 190,000 now registered for LPA, so we're pretty well spot on. Now, of that 200,000 producers who pay into MLA, at last year's MLA AGM in Fremantle, there were only 3,600 producers who applied for and gained their full voting entitlements, so less than 2%. And when we analyse the voting register, the top 40 voters control over 50% of the MLA vote. Now, the top 4 voters of those 40, 3 of the top 4 are all processors. And you think, how can a processor get a vote on a cattle transaction levy? They don't actually produce cattle. But the problem is that when it's the definition of a transaction, so when a large processor, and let's look at the 3 large multinational processors, they have extensive feedlot operations as well. So when they take their cattle from their feedlots, hold them more than 30 days into their processing facilities, that is doing a transaction. So imagine the amount of cattle that a company like JBS would take from their feedlots to be processed at their abattoirs. And this is the problem we have. The processors are blocking what producers want. So I can go along to the MLA AGM with hundreds of proxies from producers, and it can be knocked out by one processor, who is not only the largest processor in Australia, but the largest processor in the world, not based here, but based in Brazil. So, can I go back to the slide here? So, they are the basic problems we have with the MLA structure and the way it works. So, I wanted to just give a performance overview of Meat and Livestock Australia. Now remember they've been going for 15 years. They started with a $3.50 transaction levy. That levy was lifted by 40% in 2005-2006, which delivered an extra $21 million for expenditure. So this is the way the MLA sold their increase in the levy. They believe the cattle herd would grow to 30.1 million head. It actually did by 2009, it actually didn't. But here's the money that they put into those markets, hopefully to increase consumption. And as you can see, the domestic market had the biggest increase. Japan, Korea, China was fairly insignificant at an extra $300,000. Southeast Asia, North American live exports were fairly minimal as well. So they targeted those three big markets: domestic, Japan and Korea. So this extra 21 million, which fluctuates from about 19 to 21 million every year. Next slide. So this is what's happened in Korea. This is Japan, okay. So you'll note here, this is taken from the MLA material. So as you can see, we float along, and about here, they increased the expenditure to the Japanese market dramatically. The main effect we had by increasing our consumption or our beef into Japan from Australia was the USA exclusion over BSC. So the USA was cut out through a 20-month ruling, and Australian exports to Japan took off. The extra increase took into effect there, and then over time, despite the extra funding, the market continued to slide, and here we have USA back into Japan, and our beef markets, our beef volumes in Japan has continued to increase. And to take that slide further, last year we lost a further 10% year on year into Japan. America increased by about 9%. Next slide. And a similar story with Korea. So what I'm trying to point out is the lack of influence that MLA's levy money has had on those markets. Next slide. So this is the big hit. This is the domestic market, our biggest market. So remember, MLA increased that from 8 to over 17 million. Now what effect has it had? You can see here with our domestic consumption rate. So when MLA was first formed in 1998, we were around about 38-39 kilograms per person in Australia. By 2005, this had dropped to 36 kilograms per head. Last year, the consumption of Australian beef had dropped down to about 31 kilograms a head. So the domestic market is continuing to fall. We're eating less beef, people are eating more chicken and more pork at the sacrifice of beef and lamb. Now, interestingly, if I was to do the same on USA consumption, that has remained, for beef, has remained fairly static. The USA have no LIS, no LPA, and pay a $1 levy. But they have an effective grading system. Next slide. So, if you're looking to judge the success of MLA, you would have to say it's in the price that consumers pay for beef. So we paid a marketing levy to sell beef, which we don't sell. We sell cattle. It's the supermarkets who sell the beef. And if you look at this graph, you can see how virtually every year the price of beef at the retail goes up and up and up. If I took that slide further out the last 2 years, we're looking at around about, I think 2011 was $16.20, the average retail price of beef. It dropped down last year slightly to about $15.59. But they're the ones making the big money. So Australian producers receive the lowest cattle prices in the developed world, yet our consumers pay some of the highest prices or beef at retail. They're taking money out of our pockets to increase the profits of Coles and Woolworths, and as if they need any help anyway. Next slide. So what I've done here is to just put into perspective where Australia sits in the world with our cattle prices. So I've said that Australia has the lowest cattle prices in the developed world. So what I've done in the next couple of slides is I've talked about the Australian cattle price, which you can see there in relation to the other countries. And I say developed world, but look at these countries such as Brazil, Uruguay, Argentina and Paraguay, who are developing nations. They're getting more for their beef than we are at the moment. The Indonesian producer is getting more for their cattle than we are. So what I've done, so next slide. So this is how it looks on the scale of the world cattle price. Now these I got from the Irish Farm Journal, which do a regular account of world cattle prices for what they picked out to be 10 of the biggest beef producing and beef consuming nations in the world. So you can see Australia down here at the bottom. Next slide. So what I've done here is I have calculated the price of Australian cattle in relation to the minimum wages of each of those countries. And when you do that, you see Australia has the lowest cattle prices but the highest minimum wage. And this is what the graph looks like. We're on about 1.9%. New Zealand's the closest on 3%. But all these other countries are right off the charts compared to us. And that illustrates the fact that Australia has very low cattle prices, but as a consequence of our high wage structure, we're undergoing enormous costs. And those enormous costs have meant that in the last 12 years, Queensland beef producers' debt has increased from 1 to 9 billion. The average debt per Queensland cattle producer is now over 1.4 billion, approaching 1.7 billion. And this is only in the last 2.5 to 3 years. We are in crisis, and no one can run a profitable business when we have these incredibly low cattle prices. So I hope I've given you a bit of an overview of what's happening in the industry. I don't expect you to understand the structure completely. There'll be questions we can take later on. But thank you for your attention.